So, again, those funding sources, this one is not to be underplayed. You are important when it comes to funding. Lenders will not lend unless you have skin in the game. You are invested. You've got money involved in the business. You've got to be invested in your own business. You can't expect to start a business on OPM, other people's money. Lending can come, but you've got to be invested yourself. And that means that you've got to have the ability to repay the loan. And that's the critical element that the banker is going to be looking for. If you've got any type of a bankruptcy showing up in the last 7 years, it makes them very nervous. If it's in the last 2 to 3, you won't even get a loan. A bankruptcy will show up on your credit report and affect your interest rate for 7 years. It will still show up on your credit report for 10 years. So 3 years beyond, when it doesn't affect the interest rate, it still shows up, and it's kind of out there waving at the banker and saying, hello. Years ago, they wrote the book called The Scarlet Letter, right, about the adulteress who had to wear the big A around her neck. Well, now we've got the big B, you know, it's bankruptcy, and it hangs on for 10 years for crying out loud. It's hard to get rid of it. So think about that when you think about starting a business. If that's part of the adventure, this may not be the right time to think about launching a business. Traditional lenders have the availability and the interest in making loans to businesses. They want to see a business plan. They want to know that you have experience in the business. Please don't think about starting a business where you don't have experience. I have people that come to me every once in a while and say, wow, you know, I've got a passion for this thing or that thing, but I've never been involved in that industry. And that doesn't bode well, because there is so much you need to learn, and you're learning while you're losing money probably, because you're burning through a lot of profits as you're making some mistakes and not knowing what to do. So bring your expertise to the opportunity. That adds value from a lender's perspective. SBA insured loans are certainly out there, and actually the stimulus bill has even made that more important and available. Stimulus dollars are flowing into 2 primary loan programs right now, the 504 program and the 7A program. The 7A program probably saw most of the changes there. A great opportunity for putting together loan packages that can give advantages to business. With the old SBA guaranteed loan programs, there was always a fee associated with the loan application. And the fee could be quite significant. I've got a client in the Janesville area that looking at a construction project. It's $1.5 million to build a new facility. And under the old SBA program, the application fee for that project was $44,625. With the stimulus bill, the application fee has moved to a nice round number called 0, because the stimulus dollars are being used to offset the fee. The bank isn't having to eat the fee is being covered by stimulus dollars. Now, keep in mind that when those dollars are exhausted, the programs go back to the old terms. So when is that going to happen? I expect by the end of this year, certainly first quarter of next, that those stimulus dollars will no longer be available to offset some of those costs for SBA guaranteed loans. On a 7A loan, in the past, the guaranteed portion by SBA was 85% of the first $150,000 and 75% of anything above $150,000 that you're borrowing. Under the stimulus bill guidelines, the guarantee is 90% across the board. 90% across the board. So, the banker is going to be looking for a business plan that makes sense. if it's compelling. If you've got 10% down, they've got a 90% guarantee from SBA, their risk moves to 0. Angel investors. Wisconsin has been trying for a number of years now to really get the angel groups actively engaged in helping businesses start and grow. Boy, I'll tell you, it's still an adventure. Legislation was developed in 2004, and Act 255 formed the angel subsidies, angel tax credits. It also launched the Wisconsin Entrepreneurs Network at that time. To the angel investor at that time, if they invested in businesses, 25% of their investment could be written off as a loss. They get a tax deduction for that, whether the business lost money or not, didn't matter. 25% was intended to get them to be engaged in businesses that might be a little more risky. They could write that 25% off over 2 years. So that was 12.5% a year. And it gave them encouragement to be invested. What happened? Nothing. Ultra conservative. They looked for deals that would provide them only with upward mobility, and they shied away from the risky ones, took advantage of the tax credit and said, this is cool, I'm getting it on both sides. So, state legislature went back and revisited this last year. They changed the angel investor program so that they could now write off the 25% in the first year. 1 year only, 25% goes away. There's an incentive to invest in startups and riskier businesses. How has that helped? They're getting a heck of a tax deduction in that first year, and they're looking for only businesses with upward growth. So it's still not working. We've got, in the state of Wisconsin, I think 26 angel groups that are recognized by the state. You have to be registered to be part of that. If you're thinking about going after angel funds, you've got to go through an application process as well to get that approved, and they've got a very structured process to do presentations before angel groups, and getting an audience with the Pope is probably easier. It's out there. VC, venture capital, or vulture capital, depending on your perspective. We don't see a lot of that in Wisconsin. Wisconsin's kind of a flyover state for VC activity. Angels will invest in businesses. I've seen the smallest angel deal, $50,000 worth of investment in a business. Maximum angel deal, they usually hit a ceiling at about $1 million. And typically, it's a number of angels getting together and aggregating that money. So it's not a single investor putting money into a deal, it's multiples. And that way, they kind of dilute the risk. With venture capital, these people are typically looking at much bigger deals. They're generally in the 7 figures and above. Well above $1 million, oftentimes in the 3 to 5 area. With angels and venture capital, they will take an ownership stake in your business. Both of these people come in with an exit strategy. They don't want to be there long term. Angels will stay maybe up to 7 years. VCs typically want to be out and looking for another deal in 5 or less. VCs can be rather brutal. If they don't like the way the business is being run because they've got an equity stake, and usually it's a major equity stake, I've seen them fire the owner, grow the business, sell the business, and move on.